Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us here at ausbiz. Let's take a look at what happened overnight. Well, investors appearing reluctant to alter their positioning ahead of the FOMC decision tomorrow. Stocks were little changed on Wall Street while the US dollar and bond yields rose on stronger than expected retail sales and industrial production. Earlier in the session, the S&P 500 and Dow both hit record highs as investors, in fact, they retraced those gains on the release of economic data. And the Russell 2000, which tracks the small caps, investors viewing that as likely to benefit from a lower interest rate environment, it outperformed the majors. Among the Mag 7, Nvidia fell, whereas Alphabet and Amazon rose. Among the other movers, Intel gained after signing on Amazon.com's cloud services unit as a customer to make custom AI chips. Microsoft shares also rising after the AI frontrunners board approved a new $60 billion share buyback program and hiked its quarterly dividend by 10%. And shares of space exploration company Intuitive Machines surged some 36% in extended trade after NASA awarded it a contract of up to $4.8 billion for communication and navigation services for space missions. Well, US retail sales increased unexpectedly last month, dampening expectations of a 50 basis point cut by the FOMC tomorrow. Retail sales increased 0.1% in August after an upwardly revised 1.1% surge in July, with core sales, which excludes cars, fuel, building materials and food services, increasing 0.3% last month. And US factory production output increased 0.9% in August amid a rebound in motor vehicle manufacturing. The data for the prior month was revised lower, factory production rising 0.2% on a year-on-year basis. Treasury yields rose in response to that data, with the 10-year rallying to 3.64% and the 2-year rising to 3.59 after hitting its weakest level in 2 years yesterday. And the US dollar strengthened against most major currencies following the stronger than expected retail sales data, with it rising almost 1% against the yen, the Aussie, trading at 67.6 US cents. All right, let's get across what we're seeing, particularly stateside. John Blank is the Chief Equity Strategist and Economist at Zacks Investment Research. He joins us now. John, welcome back. Good to have you on the show. Of course, all eyes on the FOMC tomorrow. What are your thoughts? Because markets there's a bit of a coin toss really as to whether it's going to go 25 or 50 basis points. Do you think after that data we've just got, particularly retail sales, that 25 is looking more likely?
Andrew, I certainly think so, but the Fed doesn't talk to me. So I looked on the CME futures before the show, and there's a 64% chance of a 50 basis point cut. So I think the real way to think about whether we get 50 basis points or 25 basis points tomorrow is really not as relevant as the trifecta of what the rate cut is, what the forward guidance, because we get the summary of economic projections out to 2026 is, and what Powell's comments are at the presser. So it's going to be a trifecta meeting, and I think there's been a ton of hedging and betting around the Fed fund futures, unlike what we've seen in probably 8 or 9 years, that has sort of overemphasized the first part of that trifecta, Andrew. So I would caution everybody that we can get, until we get all three hands played, we really don't have an outlook for the Federal Reserve System over the next year or two. And that's really what's at stake here.
Yeah, what do you feel as though the risks are at play for investors ahead of this meeting, when particularly, I guess, it is all about that guidance too, with markets pricing in more than 100 basis points of cuts before the end of the year?
Yeah, well, Andrew, I see far less transmission of monetary policy effectiveness, if you want to sound like an economist, because we've already got the 10-year U.S. Treasury down to 3.64%. I mean, we've already got, basically, the Fed funds rates are 5.33%. So, I mean, just getting to where the 10-year is because of what's going on in China, we've got, 8 or 9, Fed funds rate cuts in just to disinvert the 3 to 10-year curve. The 2 to 10s have disinverted, but they're basically flat. But the real thing here is, really all that's happening here in all these markets is everybody's just saying, look at where the 10-year is. That's where the Fed funds has to go at least. And then from there, we'll see. So, I mean, I think, you ask yourself what is achieved in investment I mean, fixed investment, not just Wall Street, fixed investment, residential fixed investment, non-residential fixed investment between the 30-day and the 2-year. How many projects are out there for that lower short-term investment? Very, very little. So, you've got already the 30-year fixed mortgage rate in the United States is down to 6% before this meeting. The spread on investment grade corporate debt is like 90 basis points. It's basically nothing. So I just don't think there's any effectiveness here. So there's been just so much noise about this rate cutting, but very little understanding that if it didn't affect us a lot on the way up, why should it affect us a lot on the way down? I mean, that's kind of my thinking.
Yep, good points. John, at what point do markets start considering the US debt position, particularly, I guess, given the policies we're hearing from both Donald Trump and Kamala Harris ahead of the election?
Well, Andrew, I certainly don't think that happens till after January the 20th next year when we install a new president, one way or the other. Because, until then, it's just going to be a lot of noise about, the promises made by the different groups, and nobody's going to take it seriously. With 7 weeks to the election, if you picked up on the VIX volatility index, it is down in the 16s, like your chart showed earlier this show. But it's been up in the 20s and 30s, since August. So I think the VIX is telling you, basically we're spiking in volatility in front of that election. And then we've got to install this president. And unfortunately, given the January 6, 2021 event, we got to wait this thing out until inauguration, one way or the other. So my personal view on the fiscal policy is we really won't have any idea on the presidency and then, of course, the makeup of the Senate and the House until basically late January.
Yeah, so much to consider over the next couple of months. John, let's then take a look at a couple of stocks that you have in your view at the moment. The first one being MTU Aero Engines. This is in the aerospace and defense sector.
Right. This one we haven't talked about before, Andrew. This is military and commercial aircraft engines based in Munich, Germany. Look at that stock price. I mean, you can't get a better trading stock than this one over the last year. The only thing I would tell you is you toggle out to the 5-year, you're going to find out they're basically at the highs of about 2019 at the 149. So really a great trading stock. We have a number one rank, and you got to understand why this is, because we've got a lot of passenger travel that is buying commercial aircraft engines, and of course we've got the Ukrainian war and the retrofitting of engines and the production of engines for all the NATO allies. So MTU Aero Engines is a European commercial and military aircraft engine play, and you got to look at that chart, Andrew. And, it's a no-brainer from a trading perspective. Yeah,
you can see that trend right there. All right, the second stock we're going to take a look at, Universal Health Services, obviously in the medical and hospital sector there. Why are you taking a look at this one?
Yeah, Andrew, we talked a few weeks ago about Tenet Healthcare, which is another one of these, hospital stocks. This is just hospital stocks. So again, when people ask about the cyclicality of these markets, people don't understand in 2024, what has been quite cyclical, surprisingly cyclical, is the healthcare hospital admissions procedures business. This is just more evidence of that. You can see 24, 25, and 26 earnings for this company, which is just a hospital stock. It's hospital admissions and procedures that drive that number, are all going up. So what we're finding out here is another point of this, call it a cycle, but this recovery, this aggregate supply recovery from COVID has wrinkles that are not understood and were not predicted. What we have here is hospital admissions and procedures in the United States are going up in a cyclical manner now. And, I look into this, and I did this again when we did Tenet. I still find multiple factors here, but basically the point is, don't think about this cycle as being unlike any other cycle. It's got, significantly different drivers.
And thirdly, tell us about Aspen Technology Software Group.
Yeah, this is a fascinating one. I mean, what they are is a smaller version of SAP or Oracle. You've heard about Oracle in the news, recently. What this company does is it designs software to optimize assets in companies. So I think that means physical assets, machines, equipment, things like that. So you bring these guys in and they basically do a super efficient AI type level, performance of your machinery and your factories and optimize it. So you can see here they got a lot of red arrows. They miss a lot of times, but lately they've gotten it, kind of together the last 2 quarters. So, if you were looking for a trade here and you think this is a type of the right industry, industry software, and it's for the right area, which is all this, regrouping of manufacturing in the United States, onshoring in the United States, and you can see people are starting to buy up the stock. And if it gets over the 250 level, that previous high in 2023, this stock can move up quite dramatically. So put this one on your radar. It's not a name I personally knew about, and it's a business that basically is aligned, if you want to understand it, with SAP and Oracle.
John, always terrific to get your analysis. Thanks for joining us from Zacks Investment Research.
You bet, Andrew.
Let's take a look at where we're likely to get going on the local market. As you can see, SPY futures are off close to 0.5%. So looking to, in fact, wipe out those gains we saw yesterday. Of course, we did hit an intraday high on the ASX 200. We'll get right across that when the market opens in just a couple of moments' time. Stay with us.